All right, thanks, Brian. It has been a roller coaster week with ongoing concerns about the banking sector. The collapse of Silicon Valley Bank and Signature Bank still being felt on Wall Street. Silicon Valley is the second largest bank failure in U.S. history. Customers were pulling their money from the California-based lender before U.S. regulators stepped in. Now, a group of the nation's biggest banks is now coming to the rescue. First Republic Bank extending a $30 billion lifeline. President Biden is also now calling for tougher penalties for failed bank executives. He has said his administration is taking steps to protect American consumers and that the taxpayers will not carry the burden of the losses. So, how serious is this, though, to our overall economy? Joining us now to talk about what's really going on and how it could impact your bank account is financial expert Dewey Steffen. Dewey, thank you so much for being here this morning.
My pleasure. Thanks for having me.
Always good to see you. So let's start with the question everyone is asking right now. How safe is our money in our banks?
Your money is safe. Okay, the U.S. banking system is intact, especially if you have less than $250,000. That's insured by the FDIC. And with what you just mentioned, right now, every deposit is said to be secure no matter what the dollar amount.
So is the answer, and someone I think people are thinking this too, our money is safe for now? Could we see more banks fail? Is there sort of a domino effect that could happen here?
Again, if every bank in America failed, as long as you have less than $250,000 in those banks, your deposits are guaranteed. And so the bigger question is, again, for larger deposits, what will happen? And so that's ultimately still to be determined.
I think people are a little confused too about what happened with SVB. How did that actually come about?
Well, that was bank specific, and all of these worried banks right now are bank specific. This is, again, not systemic. And so with Silicon Valley Bank in particular, they had a very concentrated investor base, and 93% of those depositors had over $250,000 on deposits. So there was a run on that bank, and there just wasn't the cash on hand to pay everyone when they wanted their money.
Sure. Still, I think this did cause a lot of uncertainty, even at the economy. A hot labor market right now, inflation is down again. We had, as well as 2 quarters of economic growth, but still talk about a recession here. So what is your take? Are we headed for maybe a mild recession?
Well, I think, again, the base case is absolutely there is a recession coming, and you just said it, a mild recession. Now, things can get worse, and so this is a very fluid situation. But again, we would say plan for a recession. If it comes, great, you're prepared. And if it doesn't, that's okay. You were prepared, and you're in a great spot.
Let's talk about the thing you're so good at here. You just said, let's plan for what's happening next. So how does somebody make sure that their money stays their money the way that they want it?
Sure. Well, in this environment, and really all environments, the first thing is to have 3 to 6 months cash on hand. And with what's happened in the last year with interest rates and what the Federal Reserve has done, you now will be paid for that cash on hand. So 3 to 6 months cash on hand, and put it into those banks we just talked about. Don't leave it actually in your hand. And you can receive, up to 4% interest on that money. And then also, we used to say deal with debt, but now we say you need to delete bad debt because interest rates have risen, and now basically credit cards are 29.99% interest. So pay them off. Any debt over 10%, please look to get that taken care of, and then you're on your way.
Sure, and those seem like some of the basic things. What about some of the more longer-term places? Should we be looking at those retirement funds still, or do you think that maybe a recession could hit those too?
No, absolutely. Well, again, you want to buy investments while they're down, so you really want to be counterintuitive, and you wish and you hope that there are these pockets of weakness so you can take advantage. And so long-term investing or long-term planning, whether that's in your 401k or other retirement account, absolutely just keep putting it in a little bit at a time. We call that dollar cost average.
I think there are a lot of sighs of relief out there this morning, Dewey. Thank you so much for joining us.
My pleasure. Thanks for having me.